Okay, I'm recording the video now. So let's talk about the fourth type of the incremental analysis: retain or replace an equipment. So if you have old equipment, you may face the decision whether you should buy a new one to replace it or you should keep running the old one, right? That's a very typical decision. You probably have one laptop, right? You're probably struggling that too. You know, do you want to get a new one in the Christmas time, or you want to keep using it for another year, right? Okay, so basically the managers must make a decision whether to keep or replace, whether to keep it or replace, a capital or long-term asset. So how to make a decision? So basically, if the new asset, okay, the new asset help you to make more money, okay, so then you just go by the new asset, right? Otherwise stay with the old ones. So in this decision making, we do not consider time value of money, okay, or the tax implications, right? So basically in this chapter we are not talking about the factors of time value of money, right? If it's a long-term asset, right, you earn revenues over multiple years, so the future revenue, would you discount the future revenue? Here we are in this chapter, we don't consider that time value of money. And we also don't consider that the tax implications, right? CCA and income tax. There are some terminologies. Book value, right? What is the book value? So in 2100, we learned about this book value. Sometimes we call it the carrying value, right? Other times we call it book value. So what is book value? Book value is basically if you take the difference between the original cost and the cumulative depreciation, okay? And that's the book value. So suppose I buy a building, I purchased the building for $100,000. Over the years, I have a balance of cumulative depreciation of $60,000, right? So that means the total amount of depreciation I have recognized from the beginning till now is $60,000, right? So what's the book value? That's the difference. So 100 minus 60 is $40,000. That's your book value. This is a sunk cost, okay? You already paid for it, okay? It does not relevant to this decision. Remember, what's the decision? The decision is, should I retain this old equipment or buy a new equipment, right? So the book value, that's really irrelevant, right? Because you are capturing whatever the value left from what you initially purchased, right? So that's already purchased. What is the salvage value? Salvage value is the amount of money you are expecting to receive if you sell it at the end of the useful life, okay? So the asset has a useful life of 4 years. At the end of the fourth year, you're still able to sell it, right, for just a little bit of money, right? And that dollar amount would be your salvage value. Useful life, that's how long the company can generate revenue from the asset. Okay, that's the useful life. Useful life. Do we have any questions about these terminologies?
Sorry, just a quick question. Can the salvage value be 0?
Oh yeah, yeah. So it's worthless at the end of the useful life. Yeah.
Okay, thank you.
Yeah. Anybody else? Any question? No? Okay. So we are going to use one example, okay? So this company is facing this decision. The new machine will decrease the variable manufacturing cost, right? Maybe a new technology for whatever reason, right? The new technology will save your cost. In this particular question, your variable manufacturing cost will decrease from 160,000 to 125,000 per year, okay? Other information, the book value is 40,000. Is this relevant in this decision, the book value? Thomas?
It wouldn't be, no.
Because it is a
Sunk cost.
yeah, thank you. Yeah, I just mentioned this, right? I just mentioned this. So book value is sunk cost. So don't even consider, doesn't matter, right? It won't affect your decision making. Cost of your new machine, right? So that matters. If it costs arm and leg, you probably won't buy it, right? So here, it costs 120,000. Remaining useful life, so the 4 years, okay? The old machine can still be used for another 4 years. And the new machine is also have 4 years of useful life, okay? Salvage value, after 4 years, you can sell the old machine for $5,000. The new machine, that's the scenario Nima was asking. So at the end of the first year of the new machine, it's worthless, okay? So you can see this is a 4-year, we are talking about a 4-year revenue generation, right? Remember, we do not discount future revenues, right? So the time value of money is not relevant. Okay, so let's compare the two options. If you retain the equipment, so each year, the variable manufacturing cost is relevant, right? Because it's varies, 160 for option B and 125 for option C, right? So variable manufacturing or cost is a relevant cost we should consider in this analysis, okay? So, but it's for 4 years, right? So you can see the 640,000, that is the 160 per year times 4 years, you get 640. And the 125 per year, and for over 4 years, you get 500, okay? And the new machine cost that affect your option C, right? When you replace equipment, you get the new machine, that's gonna cost you 120,000. And sale of the older machine, right? Sale of the older machine, this would be your opportunity cost, right? Sorry, when you sell the older machine, okay, you can sell it for $5,000, right? So that's kind of reduce your cost for this alternative, okay? So when you add all this number together, you have the total cost for option C is 615,000, but for option B is 640. So therefore, you should go with the lower cost, right? Option, which option? Let's see who raised hands first. Jimmy?
I go with option C. It's cheaper to replace the equipment.
Okay, yeah, very good. So decision is to replacement because this option costs you less, right? You save $25,000. Okay, let's work on this one. What is the salvage value of old equipment considered to be? Let's see. I think Karen answered the question already. Did you, Karen? Did you answer the question already?
I haven't yet,
Okay.
but I think it would be an opportunity cost.
Okay, opportunity cost. Okay, Tammy?
I think it's an opportunity cost as well. because-
Opportunity cost. James?
It's a relevant cost.
It's a relevant cost, right? Because you can see on last slide, I include this number in my analysis, right? So here, okay. So on this slide, right? So this is the incremental analysis, right? You can see that this salvage value, the 5,000, is included, right? Because it's relevant. Why? If you retain the equipment, you will not sell it. You won't get the $5,000. But if you replace the equipment, you are able to sell all the ones to get $5,000. So you can see this item, the number varies, right, across the alternatives. Therefore, this is a relevant cost.
Sorry, I have a question.
Yeah.
Okay, because I said opportunity cost because I thought it was foregone. Maybe I'm missing something here. I thought it was kind of foregone to get the new one, and that was why I picked this word.
Yeah. When you are making a decision, you always forego the other alternative, right? So opportunity cost is that you have two options, right? If you pick the one option, opportunity cost is the giving up of the benefit of the potentially you can benefit from the alternative ones, right? Yeah, so here the salvage value is not an opportunity cost.
Okay.
Mm-hmm. Karen, do you have a question? No? Okay. So in this scenario, what would be an opportunity cost? Let me see. So in this scenario, what would be an opportunity cost? When you replace the equipment, you are paying $120,000, right? Here. You can say, you can always talk about what's the alternative ways of using that money, right? So, but when you compare option B and C, there is no opportunity cost. Okay, because you have the same objective to earn money. You are just trying to figure out which way to help you make more money. Okay. But when you face a different scenario, facing two different options, you might have opportunity cost. So, for example, the example I used the last time is about whether you are going to eat a pizza or you go to a movie theater, right? See, the two alternatives give you different kind of benefit, right? So if you want to satisfy your stomach, you have to give up the potential enjoyment of the leisure from watching the TV, right? Watching the movie. So that is when you choose to enjoy the food, there is the opportunity cost. You give up the potential opportunity for the leisure, right? You could go for the leisure, the enjoyment from the TV, right? From the movie, but you decide to give up that benefit and to satisfy your stomach. Okay, so that's the opportunity cost. But in this scenario, you pick B or C. You are maximizing. In your decision, you are maximizing. What's the best way for me to maximize my income, right? Does that make sense?
Yes, it does.
Okay, good. Okay, so now let's move on to this is our fifth type of incremental analysis, right? Eliminate an unprofitable product or segment, right? And so I think Sears closed down, right? Sears is like totally gone, right? They sell everything, right? Does anyone know?
Yeah, the stores.
Yeah, they sell everything, right? Yeah, it's not profitable. They lost to the information age, right? So sometimes management have to make a decision. If I have multiple production line, right? Should I discontinue one because I'm losing money from this operation, right? Why would I keep it if I'm losing money, right? So my decision is, should I keep running it, or I should discontinue it? It doesn't have to be a production line. It could be a segment or division, right? Especially sometimes when the economic pressure, right? If you live in Calgary, you know how the oil and the gas industry has been sometimes lay off people from the entire department, right? Sometimes there's a whole section, right? Whole segment. They lay off everyone, right? You know that, right? Okay, and even customers, right? Some customers are just not ideal customer, right? So maybe they are complaining too much. Maybe you don't make too much money out of them. You are losing money, right? Maybe it's really hard to maintain that customer relationship, right? It comes to the point the benefit of having this customer might not justify the cost, right? So therefore, I don't want you, right? Yeah. So you can see this are the real decisions managers may face. So what's the criteria? So basically, if you compare the two alternatives, you go with the alternative with better income, okay? If just from the financial perspective, okay? And of course, we still have to consider non-financial factors, right? So if you are much better, if you are better off overall, right, to drop it, then you should discontinue, eliminate that option. The key is that the fixed cost, okay? The key you want to be careful is, right, the different alternatives, how the fixed cost will be changed, okay? So basically, the different alternatives, okay? So can the fixed cost avoid it, or it's unavoidable, okay? So it's interesting when you see a question, you know what I'm trying to say. Is fixed cost a relevant cost, right? So basically, if the alternatives, you can avoid the fixed cost or avoid fixed cost partially, you are making fixed cost to be a relevant cost, right? But in other situations, it's like, fixed cost is always the same. Doesn't matter if you are eliminate that operation, okay? So I'm going to give you one example. So suppose we are talking about a scenario. This is a teaching institution, and there's one teacher we pay him $60,000, okay, a year. And the teacher is responsible for 3 courses, math, social science, history, okay? And so the tuition fee we are able to earn from the different courses are the same. So each course, we earn $25,000 tuition fee, okay? But the teacher spent different times in each course, okay? We are going to allocate the fixed cost into each course based on the time they spend on the course. So we know math is really hard, right? For most students, math is very hard, and the teacher spent half of her time to teach this course, and the split the other half time, 1/4 for each social science and history. These are relatively intuitive, easier to teach. So the total fixed cost is 60,000, okay? And I'm going to allocate it based on the time the teacher spent on the course. Can anyone tell me what is the allocation of the fixed cost to each course? It's not that hard, right? It's pretty straightforward. Kate.
30,000 for math and 15,000 for social science and history for each.
Yeah, thank you. That's it, right? Based on the time. So if you spend half time, so allocate half of fixed cost. half of the 60,000. So that's the 30,000, right? So now let's see. For math, what's the income? For math, I earn 25,000, but the cost is 30,000. So I lose $5,000. For social science and history, for each of the courses, I make $10,000. 25 minus 15. So what's your decision? Now you see this. What's your decision? You have to make a decision, right, Erin?
I think it's better to drop math.
Okay. So now let's highlight math, right? Because we're losing money on math. So we should drop the math, right? Okay, you drop the math, okay? So the teacher will teach social science and history, right? So now the teacher spend half time on social science and half time on history. What's your fixed cost allocation is like? What's your Michaela?
So then you would be at 30,000 and 30,000 for each course.
Okay, so if I allocate 30,000 for social science and 30,000 for history, what happened to these two courses? So this number is 30 here, 30 here. What's my income for each course? Michaela?
Both their income will increase then to to 15,000, sorry.
Increase, are you sure? So the revenue is 25,000 and the cost will be 30,000, right?
Oh, sorry, then you'll each have a loss of negative 5,000.
So then what are you gonna do? You are going to close all the courses, right? Right? Because you are losing money. So if you take a look at the whole picture, the total revenue is 75,000, right? And the total cost is 60,000. So every year you are making $15,000, right? So if you keep as it is, every year you are making 15,000. But if you follow that path, if you close math, right? And then you realize that you have to close the whole business. And that is interesting, right? Why this is a profitable business, you are making $15,000 a year. How come it ended up to be a full closure, right? Does anyone know what's the issue here? Does anyone know what happened here? Why it's like this? Irene?
I'm thinking that maybe they're not producing enough income to cover the fixed costs.
Mm-hmm.
So
Okay.
they need to teach more students. So they would have like more tuition.
Okay. So I want you to think from the last slides. Okay. Think about it. The key is the proper handling of fixed cost and determining if such costs are avoidable and unavoidable. If it's unavoidable, that means fixed cost is irrelevant, right? If fixed cost is always the same, regardless you close the course or do not close the course, then fixed cost is irrelevant. In your analysis, you should not consider it, right? Okay, so now I want you to look into this again. So why don't someone tell me, is fixed cost avoidable in this scenario? So the decision, always remember what's your decision making, right? The decision is whether I should get rid of math, right? That's the two alternatives. You keep the math or you get rid of the math. So my question for you is, if you get rid of math, can you avoid that fixed cost? Just give me 1 second. Let me see who raised the hand. Jimmy?
Well, you would still have to pay somebody to teach at the rate of $60,000. So that rate is unavoidable, but you've lost the tuition income from math. So that's why you would have the net loss in the end.
Okay, bingo, bingo. Okay. So fixed cost is irrelevant in this scenario. Okay, even you get rid of the math, you still have to keep this teacher and pay the same amount of money, the $60,000. So this fixed cost is not avoidable, it's unavoidable, right? That means the fixed cost is the same amount under the alternatives. So it's irrelevant. So what then in my decision making, I'm going to see if I get rid of the math, I'm going to lose that $25,000 revenue. And I'm not saving any cost, right? I'm going to lose that revenue, 25,000, but I'm not saving any cost. So why would you get rid of math, right? Does this make sense? Yeah. Okay, if you understand, please give me a thumb up. Okay, that's good. I think almost everyone got it. Good. Now let me ask you a question. If I change the question, the scenario, we talk to the teacher because now you are not a full-time teacher, right? You don't teach math anymore. Therefore, we don't pay you the $60,000. I'm only going to pay you $30,000, right? Because we only need you to work like half time, right? That's enough for the social science and history, right? So now I'm not going to pay you the 60,000. I'm going to pay you only 30,000. Okay. So now what's your decision? This is the problem when you have students achieved the 10 participation marks, right? All of a sudden they lost the incentives to participate.
Well, we would want to, oh, sorry, I should have raised my hand.
Yeah, go ahead, Rylan. Yeah.
We would want to keep math open, right? Because fixed costs would be down.
Yeah, so I will say the question again, right? The scenario is a different scenario now. So basically now we are saying, because you do not teach math, right? So you only work half time. So I'm going to pay you half. So the fixed cost would be 30,000, not 60,000. So under that situation, what's your decision? Should you keep the math or you should close it?
Okay, but does the revenue stay the same?
Yeah, the numbers, everything else is the same. It's just the difference. The difference is in this scenario, the teacher's salary is cut by half.
We would want to keep math then, right?
Okay, well, thank you. Thomas?
I've already participated, but you want me to answer still?
Well, nobody else is raising the hand, right? So they choose not to participate. Yeah.
Okay.
I'm
well,
trying really hard to give people the opportunity to participate, but you can't force them, right? So
yeah.
Go ahead, Thomas. Yeah.
Well, because you can get rid of some of your fixed costs of 30,000, then you'd be able to keep social and history. So that you'd be able to keep the profitable lines and close down your math, which is
okay. Yeah, very good. Yeah. So in this scenario, the fixed cost is avoidable, right? It's avoidable. So when you get rid of this math, you also get rid of this fixed cost, right? Because that's how you talk to the teacher. You are not teaching math, therefore we are only pay you half time, right? That's the time you spend for the social science and history. In that scenario, so basically fixed cost is a relevant cost, right? And how relevant? If you close the math, you are going to save a cost of 30,000, and you will lose that $25,000 revenue. But together, your saving is 30,000, right? So when you add this together, you still save $5,000. So if that's the case, you have to close it, right? You need to close it. You are saving $5,000. Okay, does this make sense, guys? So I'm hoping using this example to help you understand what do we mean by fixed cost? Why is that important? And what do we mean by avoidable, unavoidable, right? How does that affect the decision? If this makes sense, please give me a sum up if it makes sense.
Yeah, I was looking at the question wrong, but yeah, I see it now.
Okay, awesome. Okay, so if it doesn't make sense to you, make sure you ask me, okay? Okay, so let's move on. Okay, so basically, you want to consider the effect on related production line or segment, okay? Fixed cost allocated to the unprofitable line or segment must be absorbed by those that remain, okay? So remember that's $30,000 we allocated to that unprofitable math course, right? Because that fixed cost is not avoidable, right? You already signed a contract with the teacher, right? You are committed to pay her $60,000. Therefore, right, that fixed cost has to be absorbed by the other production lines that remain. That is the history and the social science, right? So now your cost for the other two section increased, right? And we have seen the scenario then everyone is losing money, right? Everyone is losing money. So you're better off close it down. This is kind of like a death spiral, right? Death spiral. So the net income may decrease when an unprofitable production line or segment is eliminated, okay? So that's exactly our scenario. So let's take a look at what happened, okay? So let's go back to this scenario. Before, if you keep the math, what's the total revenue? Total revenue is 75,000. What's your total cost? Total cost is 60,000. Your income is 15,000. If you get rid of it, your total revenue is 50,000, and your total cost is still 60,000. And then you are losing $10,000, right? So that's the thing we are saying. If you get rid of an unprofitable production line or segment, your net income may decrease. Why? It's possible the fixed cost is unavoidable, and that unprofitable production line is allocated with a large amount of fixed cost, right? So maybe the reason why that the production line is unprofitable is because that production line ate up a large portion of the fixed cost, okay? So what's the decision criteria? So basically, you know, if you get rid of that production line, the saved or eliminated fixed costs are greater than the lost contribution margin. So back to my example, if I'm able to reduce the fixed cost by 30,000, right? If it's not a contract, if we talk to the teacher, guess what? You know, we are not teaching math, we pay less, right? If we are able to reduce fixed cost by 30,000, and that's more than the benefit, 25,000, right? So we should just get rid of that section, okay? Does this make sense? Give me a thumb up if it makes sense, because I'm concerned that you may be confused here. Do you find that the course example helps? That's the first time I use that example. I'm not sure if it's useful or not. Maybe give me some feedback. Do you find that example I used helpful, or I confuse you even more?
Yeah, I thought it was helpful.
Okay, good. Awesome. So let's keep going. So this is one example. You have 3 product lines, right? And we know the sales number, we know the variable cost, we know the contribution margin, and we know the fixed cost allocated. Okay. So now, what's your focus now? What did you see? What's your decision you are making? You need to make. Karen?
Well, just looking at it, I'd like to get rid of the champ line because initially it's losing money.
Okay, yeah. So now you see, oh, wow, this one net income, this production line is losing money. Should I get rid of it, right? And then, okay, so that's the information. Do I have more information? Let me see if I have more information. Okay, I do have more information here. So the actual fixed cost will not change if that unprofitable line is dropped. So basically, you know, the fixed cost 160,000 doesn't change. Okay, if you dropped this line, that $30,000 has to be allocated elsewhere. Okay. So the question is, should ABC company drop the unprofitable production line? Should we drop it? By dropping the production line, oh, did I tell you this answer already? Okay, so should we drop this line or not? Isabella?
Isn't it yes, because we're losing money from it?
Okay, yes. Okay. Nima?
At first I was thinking yes, because if we drop it, then we'll save on the variable cost.
How much did you save?
Or how much? 90,000, I think, is it?
What? Yeah, you saved the cost. What did you lose?
I lost, let's see. Oh, the selling minus variable, so that thing, I forgot the name of it.
Yeah, the contribution margin, right?
Yeah.
So if you close champ, you lost contribution margin, right? How much did you lose?
Are you still talking to me? The 10,000?
Yeah, okay. So basically the contribution margin you are losing, you are losing is 10,000, right? And how about the fixed cost? Can you save any fixed cost? No, right? You do not save the fixed cost because the fixed cost that won't change, right? So if you close it, you just lose $10,000. That's it, right? So you should not close it. Okay, you should not close it. So by dropping this line, you are losing that $10,000 contribution margin, and you do not save any fixed cost, right? Because the actual fixed cost will not change if you drop this line. So there's no cost saving by dropping this line, but you lose that contribution margin. So you should not drop this line. Laimi?
Yes, Professor, I was wondering if you could clarify that, because if we're not making any money, are you saying we should just hold on to that product just because of its contribution margin? How does that help financially?
It helps you to have $10,000 more money, right? Having this line, generate $10,000 contribution margin. It helps you, right? And
But we're losing $20,000 in net income.
The reason for that is because you allocate fixed cost to this production line, right? You allocated $30,000, the fixed cost to this production line, right? And you can't get rid of this cost if you get rid of the champ. So that cost will go to the pro and the master, right?
Oh, okay. Okay. So that way you can spread the cost across those products. Is that it?
Yeah. So basically, when you have the allocation, you have a production line. This production line will bear some of the fixed cost, right?
Okay. Okay. Yeah. Okay. Okay. That makes a lot of sense. Thank you.
Yeah, and it doesn't make it more or less, right? But you having the production line will only, have the $10,000. So it's just like the teacher's example, right? Maybe I didn't do a good job explaining it. I just don't think it should be that complicated. So think about that, right? You pay this teacher $60,000 a year anyways, right? And she has the capacity, she has the time, right? And you can use her to, teach math to make $25,000. Why don't you do it? What's the reason for you to not to do it, right? You sign the contract, you are paying the teacher $60,000 a year, right? And she has the capacity to teach math. And you can make a tuition like $25,000 for teaching math, right? So it'll be very silly, right? to close the math, right? Does that make sense?
Yes, sir. Yes, sir. It does.
Yeah, the cost is there regardless, right? So this fixed cost, the $160,000 is there regardless, right? So that including this $30,000. If you get rid of this production line, you can't get rid of the $30,000 cost, right? Because we were told that this is the fixed cost, right? So then really what matters is that if you get rid of champ, you lost this contribution margin and you are not saving any cost. It'll be very silly to close this production line, right? Does that make sense?
Yes, sir, it does. Thank you very much.
Okay, awesome. Okay, so let's move on. Okay, so let's work on this question. You tell me what's your answer, okay? Isabella, you have an answer already?
Oh, no, sorry, I left that up.
Okay, Karen? Okay, I see. Tammy?
I think it will drive operating income. It will decrease it by 500. C.
The answer is C. Okay, 500. Okay, thank you. Anybody else? Nobody? Okay, so Tammy, can you explain why?
That's because the fixed cost is actually distributed between product A and B. So if they drop product B, the total fixed cost is going to come back on product A. And when we take it out from the contribution margin, it's going to decrease operating income by 500.
Okay. How did you use the information, the 40% and $2,000? Did you use that information, the 40% and 2,000?
Oh, no, I did not. No.
Okay, it's funny because your answer is right.
No.
but it should not be that. It should not be that rationale. Okay, it's not that rationale. But your answer is right. So, I don't know. This is a very interesting coincidence. Yeah. Okay, so the benefit of if you get rid of B, A will increase by 40%. That means the contribution margin of A will increase by 40%. So 5,500 times 40%, that's 2,200. So you're going to increase your contribution margin on A for 2,200, right? And also you are going to also save the cost, the total fixed cost by 2,000. So the benefit is increase contribution margin for 22 and plus 2,200 for the fixed cost saving. So together that's 42, right? So that 42 benefit still does not justify the fixed cost bite by this production B, right? So 4,200 compared to 4,700, right? So basically, when you get rid of B, right, your income will decrease by 500. 4,700 minus 4,200. So the answer is C. Okay. Okay, so let's see next one. How much time do I have? Okay, I still have 15 minutes. Okay, the last piece of this is the allocated limited resource. Resource is all, there's always a limitations in the resource. We call it a scarcity. That's the concept for the economics, right? If you have taken those two economic courses, right? So resources are always limited, right? We have limited amount of time, we have limited amount of money, right? Even we have a limited amount of energy, right? You can be super high all the time, right? So, so here, Karen. That's a legacy hand, maybe. Okay, so management has to decide how to allocate these limited resources across different product, right? they have different options to do things, to use these resources, right? You can use your time, right, to study 2400, or you can check on your Facebook. How many people are checking Facebook right now? Please raise your hand. Two? Okay. Okay, thank you for your honesty. I really appreciate that. Okay. Okay, so that's basically the decisions we are making all the time, right? So so the idea is how to allocate your resources to maximize the performance, right? You may want to think about, in the long run, right? In 5 years, right? Who you want to be, right? Where do you think you are, right? And then it's important how you're going to allocate your resources today, right? Everyone have the same 24 hours a day, right? How do you want to allocate the time? So sometimes we only see the end result. We are saying, oh, he got multiple job offers, right? He's lucky, right? Maybe not, right? Maybe there's a reason for people who achieved that, right? You only see the end result, but you didn't see the preparation, the effort, right? So the idea is everyone has limited resources. It's up to you how to allocate it, right? To optimize the performance, right? So here we are trying to, we are trying to identify what is the limitation, right? And then we figured out how that limitation, the resource, is transferring into money, right? It's too bad, right? In business, we talk about money all the time. And then you want to talk about, for every unit of my resources, how much money I can generate. And then I go with the option that maximize that revenue generation, right? Yeah, for example, right? What would be a good example? I'm just thinking about, can somebody give me a good example? You have limited resources, you identify that resources, and you figure out what's per unit. Okay, I got one example. Okay, so my limited resources is my time, okay? So, and that's based on per hour, right? And I can use this 1 hour to generate revenues. I can go to McDonald's, okay? If I work in McDonald's, they pay me $15, okay? That's the revenue I generated. If I use my 1 hour to teach you guys, I got to pay the $200, okay? If I use the 1 hour to watch TV, I wasn't paid anything, right? But I get a leisure, right? I don't know if you can measure the value of the leisure, right? And so the idea is, eventually the idea is you kind of mentally attach the value to the different alternatives. And for sure, right? For sure that I will not go to McDonald's, right? Because I have a better alternatives to come here to teach you guys, right? So that's the idea. But the business, they are facing that direction because they are limited resources. They want to figure out what's the benefit they can obtain from each unit of their resources, right? And then once they see the number, it's pretty clear, right? How they're going to allocate their resources. So you select the product or the product combination that maximizes the net income, okay? So this one example is that I know the limited resources is the machine hours. So every month I can only run my machine for so long, right? Right? Every month you can only run your machine for so long, right? There's a limitation. Suppose it's 3,800 hours, and you can potentially make 2 items. The phone case either standard or dilute, and the contribution margin is $8 for number 1 and $6 for number 2, right? And then for each unit, you need a different amount of machine hours, right? 0.4 machine hours for the number 1 and 0.2 for number 2. Now I need to work out for each unit of my limited resources, which is a machine hour. So for each hour, each machine hour, what is my contribution margin for the 2 production, right? So I do a calculation. So basically, each machine hour will help me to generate $20 contribution margin for the number one, but it's gonna help me generate $30 for number two. So which one you want to go? Well, $30, right? Not $20. So the idea is you want to first allocate the resources, the machine hours, to get all your production done for the standard cases. Then whatever left, you're going to use for this one, right? Okay, so basically you go with the higher contribution margin per unit of limited resources. In this case, is the per unit of machine hour. Okay, so short-term decision is you focus on the production yield the greatest contribution margin per unit of the limited resources. In the long run, you want to consider how can I increase the capacity, right? How can I, reduce the constraint, right? So for example, how can I increase the machine hours? Can anyone tell me? Ruben?
You could increase the amount of money you spend on machine hours.
How can you increase the limitation? How can you increase the amount of machine hours?
Oh, buy more machines?
Yeah, exactly. Very good.
Yeah.
Yeah, you buy more machines, right? Yeah.
Okay.
Very good. Yeah. So change the contribution margin per unit of the limited resources. So how can you do that? Change the contribution margin per unit of limited resources. Maybe that's about efficiency, right? Before you have a process that are not efficient, it takes longer, right? It takes longer time for the machine to do the product, right? Maybe you have a better idea to refine that process to keep that time shorter, right? Okay, so if you were able here, if you're able to reduce the machine hours for this product, let's say by half, so $0.2 hours for this case as well, then $8 divided by 0.2, you get $40, right? So then that will change your decision making, right? Okay. Okay, so we are good with this. So how are we doing with time? We still have 9 minutes. So incremental analysis, theory of constraints. Okay, so it's really important, right? How you gonna find out this constraints, right? So in an organization, it's very big, large, right? There are all these weak points, right? These weak points. How can you identify them, right? What are the weak points, weak spots, right? And you have to make it stronger, right? In order to maximize your performance. First, you want to see where are the constraints, right? Oh, I have this machine. I can only run this machine for so much longer, every month. And then you try to reduce or eliminate the constraints. So if your production level is up, you want to restrain the constraints or eliminate the constraints by investing more into the resources, right? Buy more machines. Okay, so let's take a look at this question. You know the answer, right? So if you don't raise your hand, that means you're just being incooperative. Lenny, thank you. Oh,
I think it's C.
Yeah, thank you guys for whoever raising the hand. I'm gonna call your name, okay? And you tell me your answer. Let me, Karen?
C.
Michaela?
Also C.
Janaya?
C.
Kate?
C.
Dan?
C.
Patricia,
C.
Maddie.
C.
Okay, thank you guys. So the answer is C, right? The answer is C. Okay, so that is the last question. So let's work on this question. Okay, so Thomas.
Should be A, I think.
Okay, let me see. You said A. Okay, let's see other students. Karen.
I say A.
A. Michaela.
Oh, sorry, I didn't have this
Okay.
one.
Yeah, Maddie.
My dog's barking, but I was going to say A.
Okay, Ruben.
I agree with A.
Okay, good. So the answer is A. Yeah, so you figured out the contribution margin. So selling price and the variable cost, take the difference, should be 3.4. And then you are working on per unit, right? So the machine hours for each unit, that's the 4 hours, right? So you want to figure out per unit hour. So 3.4 divided by 4, that's 0.85. Right? So that's the contribution. That's the contribution per machine hour, machine time. Okay. Is this okay? We are done. Okay, isn't that perfect, right? We still have 5 minutes. So I'm going to stop.